I'm Peter Ellsworth from Ceres. If any of you are not familiar with Ceres, we are a near 30-year-old nonprofit organization based out of Boston that's been working on sustainable capital markets for a long time with investors and companies. The key word in our panel's title today is long-term. The missing word is sustainable. Any long-term investment these days needs to be sustainable. Infrastructure, for example, needs to account for climate-related risks that were not as front and center a decade ago. This question was asked, what's the roadblock? What's keeping capital from being deployed? I think there's a tendency to point the finger at investors for not investing quickly enough. But I think that the principal roadblock may be at the project level, which is one of the things we'll be tackling today. Infrastructure done as usual is easier to do. It's cheaper in the short term, and often determined by some combination of local cronyism and the lowest bid. A sustainable project means that the RFP needs to be rewritten. Our panelists today have the experience of finding common ground between those who have capital and those who need capital, and communicating to project developers and financing entities how investors want long-term investments that transparently address how these investments are sustainable. Our panelists are Caroline Angoorly, Chief Operating Officer of the New York Green Bank, who has more than 20 years of domestic and international experience in business building, strategy, operations, project and asset management, investment, project finance, and M&A. Kathy Boffman-McLeod is Senior VP in the Global Environment and Social Risk Practice at Bank of America, where her focus includes issues around climate-related financial risk and disclosures, emerging social and environmental risks, and building and executing a resilient portfolio. She was previously Managing Director of Climate Risk and Investment at the Nature Conservancy. Ken Locklin on the end is a director at Impax Asset Management, where he leads their North American outreach activities on issues related to climate change and sustainable investment. Ken also collaborates extensively on these issues with a variety of interested institutions. He brings the perspective of more than 25 years in clean energy investment and finance. And to conclude the introductions, Curtis Probst is currently a director at the New York City Energy Efficiency Corporation. This is a problem of double-sided printing. On the topic, and he's also a lecturer at Columbia University on the topic of clean energy finance. Curtis's prior experience includes 3 years as a managing director at Rocky Mountain Institute, which is a global energy think tank, and 15 years at Goldman Sachs in their investment banking and fixed income, currency, and commodities divisions. This is a great panel, and we're going to get this started with a question for Caroline from the New York Green Bank. Can you tell us how the New York Green Bank is working with larger cities and smaller municipalities across the state to finance infrastructure, and what sort of projects has the New York Green Bank been involved with thus far that have helped advance urban sustainability in New York?
Great question. Thank you, Peter. Thank you, everybody, for attending the session today. Very happy to be here to at least whet your appetite on what New York Green Bank is and does for those who are less familiar. So, top line, we're a $1 billion fund funded by the state of New York. We're active in clean energy, sustainable infrastructure investments in the state of New York and giving financial benefits in that we have to be a self-sustaining entity. and also environmental benefits. So to your question, what we find that our niche is we're looking at market barriers and gaps in financing. So what is it that as the energy model and the energy infrastructure is changing radically from a central hub and spoke model to this more distributed two-way energy grid and a smart grid, what is it that is really happening? And that is traditional project financing is not the way these things are necessarily done anymore. The model is changing, that we've now got different types of developers. They can be ESCOs, they can be installers, they can be aggregators. We're dealing with credit profiles of projects, whether it's residential solar, residential efficiency, small C&I on landfills in municipalities. We're dealing with credits that are different from what people are used to historically with project financing. Sometimes we're dealing with technologies that also have less of a track record. And we're dealing with asset classes that are still very nascent, not a lot of liquidity, and so there is also not a lot of performance data. So what does New York Green Bank do? New York Green Bank is some examples of what we've done in New York City. We've worked with Motivate, and Motivate is the parent company of City Bike. So City Bike has, it's a company that is established. It's the largest actually bike share company in the United States. But they were having trouble getting financing that reflected their stage of evolution as a company. They were no longer just a bare bones startup. Very popular in New York City, but they were having trouble getting the financing to expand to areas that are not in Manhattan, so further out in Brooklyn, further out in Harlem and Queens. And so what we've done is we've provided nearly a $50 million facility to allow them to expand to these areas, to bring sustainability to people, sustainable transportation choices to people who, might not be close to a subway, and also there are the health benefits. We've entered into a transaction with NYCEEC and other public housing authorities to be able to help them finance energy efficiency retrofits on 18 to 20 buildings that saves millions of dollars per year. We enter into energy efficiency transactions with things like aged care homes. And again, what we're able to do is we're able to provide structures of products that maybe aren't available in the commercial mainstream, and we're able to provide a tenor that is longer to allow deeper retrofits and still support the payback.
Thank you. Next question's for Kathy, and as background, green bonds is a subsector of green finance, but an increasingly growing and important one. And your bank is heavily involved with green bonds as an underwriter and an investor. Tell me how your bank is using green bonds to address the sustainability needs of cities.
Thank you very much, Peter. Hi, everybody. How are you doing out there? You fired up? All right. So first, I'm not going to tell a joke, but I'm tempted. I want to ask anybody who has an account with Bank of America or did bank with Bank of America or works for a community or a company or a city that has a relationship with Bank of America or Merrill Lynch, would you mind raising your hand? I want to say thank you very much for your confidence in Bank of America and for your business. I am new to Bank of America. I will have been here for 3 months at the end of April. And so it's a big place. I'm learning all about the lines of business. But the one thing I'll tell you is that the reason I would come from a nonprofit like the Nature Conservancy, and you can assume an ethic of wanting to help the world and do good and sustain us all and the planet we live on. Yes, I have that ethic, and I think we share that ethic as a community here in the room and beyond, of course, that the Bank of America also shares that ethic. And the commitment of $125 billion in capital deployed toward things that are good for the planet, climate smart and low carbon economic transitions, that's where we want to put our capital. And part of my role is to help contribute to the way that we do that. And green bonds is a key part of that. And just in the first 90 days of this year, $28 billion in green bonds have been issued, and that's the biggest number ever. Bank of America has 24% of the market share of green bonds, and I think the challenge for us, for the bank and for us as a community, is to think about how those green bonds deliver the results that we're looking for the sustainability in those communities and the metrics that we need, and thinking about the application of green bonds to resilient bonds and to blue bonds, and generating the data necessary to show the performance of the bond is effective. And that could mean all kinds of activities of collaboration and aggregation and using blended finance to get to that standard of data collection about how those bonds are being impactful. One of the things I'll also note is if you look at the history of the use of proceeds of the bond, starting in 2013 with the first one, the only use of the bond was general purpose financing. And so we're going to try it out, we're going to use general purpose. And as each year has passed, more diverse and interesting uses and applications of the bonds. And I think there is hope, not just hope, but you can see strong growth in the size of the bonds, but also in how communities are thinking about how to use the bonds. And so I'd like to think about how, as we come out of this gathering, how we can work together to bring some of the data that's necessary, the standards, and some of the partnerships with the entities around the table that are anywhere from full philanthropy, to market rate and everything in between, together to deliver a little bit bigger, more tailored, but also impactful green bonds. I also wanted to say that 30 of the 50 states are using green bonds in some way, and I think that's really encouraging to go from a couple of states to see 30 of the states. And I'm just talking about the U.S. Of course, there are immense use and application of green bonds outside of the U.S., and we have a green bond hub in London. So I'll stop there. There's lots to talk about here, but I can see that you all are fired up and ready to go, so hang on to it. Don't let it go.
Another low-tech question for the audience. How many in the audience are investment professionals? And how many would characterize yourself as issuers? I mean, one of the interesting things that characterizes green bonds is that really for the first time ever, fixed income investors are asking, what's my money being used for? What's my capital being put to work to do? Fixed income investors normally see a credit rating, and they buy the bond and put it in their portfolio. Green bonds give them the opportunity, and in fact the necessity to ask how the proceeds are being used, and they're also an important sort of catalyst for dialogue between investors and issuers. I have a question for Ken. Your European funds focus on urban real estate that's been rehabilitated. This is more difficult than it sounds because someone has to commit to the rehabilitation or the retrofit to get the process started. Can you tell me where the support comes from to develop these kinds of projects?
Sure, Peter, thank you. And let me back up a step because Impax is not a household name here in the U.S. to provide a little bit of background. Impax is a London-based asset manager. It was launched just about 20 years ago, and for the first 10 years of its operations, it exclusively invested across a range of environmental markets and climate solutions listed equity companies. And it was successful over that period and beat benchmarks and drew some additional investors. But then the team was interested in expanding their reach and moving beyond the very liquid equity investments to look for opportunities to make longer-term commitments in the market. And we did that first about 10 years ago by launching the first of a series of private equity funds which invest in renewable energy projects in Europe in the case of all the investments so far. And that first fund birthed a second fund, which birthed a third fund, so a very successful process there for committing to the assets which would generate large-scale, utility-scale power, clean power, which fit into this broader mandate of the Impax Institutional House. About 5 years ago, we were thinking about where else we should be looking in the market, and the question Peter raised about the necessity of dealing with energy efficiency in an urban real estate environment became really clear to us intellectually, although we had no commercial exposure to it. And we decided to expand our team's operations to develop a financing capability in the commercial real estate market. So to Peter's question, the logical thing to think about, there are two ways to approach that. You can do new build, very efficient structures. There's a lot of competition, frankly, for new build, very efficient structures. And it turns out that at the end of the day, they're a fairly small percentage of the total market for real estate in any city. So we wanted to find a way to be more responsive to the realities of the market, which, and you can see this looking around us, there's some beautiful, very high-tech buildings, including the one we're in, and there's some buildings that still have useful life, but are not nearly as sophisticated in terms of their engineering or efficiency. So we took the approach of looking for a way to tackle that challenge. And what we developed over the last 5 years was a process by which a team that we've built will identify opportunities to invest in properties that are less than what we would call in the States LEED, Gold, or Platinum standard, retrofit those properties and sell them. And to Peter's question, how do we find the funding for that? That's what we do. We actually commit our capital and the capital of our investors to acquire these properties. They may be 10, 15, 18 years old, retrofit them to the equivalent of LEED, Gold, or Platinum standards, and then sell them out in the market. We do this, something all of you know, because there is a very strong market for green property from a real estate point of view. There are premiums to be paid for real estate in such buildings. The turnover is lower, the release period is shorter, so from a commercial point of view, very attractive. And once we have converted those properties, we then turn around and sell them to institutional investors after a period of years, who hopefully then own them for an extended period themselves. It's this kind of buy, fix, sell model has been effective for us. We only work in the UK. This team is UK based, and we've worked in the first fund exclusively outside of London. We're now looking at some other investments to broaden the scope of that work. But I think it's another example of how financial professionals can bring their technical skill set and the capital, the wall of money that is in fact available and viewable on the distant horizon, to address this very important process of the retrofit and the increase in efficiency that we all have to accomplish in order to live in the built environment.
Thanks, Ken. I mean, a common theme that we hear about all the time is how do we scale up the investment? How do we scale up the opportunity? And there are lumpy transactions, but there are also a lot of smaller deals that need to get done that contribute to the overall flow. So my question to Curtis, which is actually a pretty logical question for one nonprofit to ask another, is how does your work as a nonprofit organization help catalyze opportunity and accelerate this transition?
Great. So thank you very much for that. And thank you to the organizers for the opportunity to be here today. First of all, like many of the panelists, I wear a couple of different hats. Given the topic for today's forum, I'm here principally as a director of NYCEEC, the New York City Energy Efficiency Corporation. You heard from another member of the NYCEEC board earlier today, Bruce Schlein, in addition to his role at Citi. Also in the audience, you have Susan Leeds, the CEO of NYCEEC, and other members of the team. So just to level set in terms of what NYCEEC does, NYCEEC is a nonprofit corporation founded in 2011 by New York City. Its mission is to innovate and deliver clean energy financing solutions for buildings. Over time, it's moved beyond its original mission to focus solely on energy efficiency. NYCEEC now looks at renewables, it looks at storage, it looks at other parts of the clean energy equation. It also has a slightly larger geographic area, in part to develop relationships with contractors, vendors, energy services companies to help them move into New York City by developing financing relationships. So we heard earlier this morning that finance is not a problem. So if finance is not a problem, why are we here? We'd have to come up with a new title for the conference, I guess. And why do we have entities like NYCEEC if finance is not a problem? I agree with the assertion that finance is not a problem with a couple of caveats. One is that finance is not a problem for projects that have an adequate perceived risk-return trade-off. So specifically that the returns justify the risk that is perceived by the market. And I use the word perceived quite intentionally there. Finance is not a problem for projects where there's adequate information to make that evaluation. But as Caroline mentioned, many parts of the clean energy system are nascent markets where there isn't the information. Finance is not a problem where projects are available at scale, where you can do one financing and then very quickly do 5, 10, 50 other financings, where you can take those financings and repackage them, where there's a range of capital markets options, warehouse lenders, whole loan sales, securitization, other forms of financing. But this isn't the case in many segments of the clean energy markets, particularly in cities. So to just restate it differently, we see three main barriers in financing sustainable cities. The first is the risk-return trade-off. Second is information, or specifically the lack thereof. And third is scale, or again, the lack thereof. So NYCEEC is addressing each one of these and other barriers in different ways. So for example, risk-return. There are some segments of the market where the perceived level of risk is not compensated by the returns available in the market. I think the place we see that most notably in cities is in the affordable housing market. Interestingly, I think affordable housing and low-income segments of the market are often equated with poor credit quality, and we just don't see that to be the case. But from a perceived risk perspective, I think it is the case that most people think that that is a riskier segment of the market. NYCEEC is founded as a not-for-profit and can therefore attract lower-cost forms of capital, grants, PRI monies, or program-related investments, CRA or Community Reinvestment Act monies, and so has a lower source of capital. So can in turn charge a lower return, so projects that would not be financed by regular commercial lenders can be financed by NYCEEC. So if you look at the NYCEEC portfolio, it's 17% multifamily affordable housing. That's something the NYCEEC team should be very proud of because that's a very difficult segment of the market to tackle. Next is on information. You know, I think there are a lot of places where there's a dearth of information. If you look at building energy efficiency, we do not have years and years of data on how these energy conservation measures perform. That would be a great thing to have as a lender, especially if you're financing the savings stream. We don't necessarily have that information. You look at storage, battery storage is a relatively new technology in deployment. We do not have lots of information. What does that revenue stream look like? How much is it worth to save demand charges in 2023? Gosh, I don't know. That's an area where there just isn't the information. But yet, as you learned from Bruce, who stole my thunder with taking the Marcus Garvey case study this morning, NYCEEC has financed battery storage in a battery storage microgrid, the first in New York City in a low-income project. So sometimes through both the technical expertise that NYCEEC brings to bear and through willingness to take a little bit more of the risk to catalyze a market, they're willing to finance things where maybe there's not the same level of information that might be available in the markets. Finally, scale. You know, in my banking career, I figured out pretty quickly that it's as much work to document a $10 million loan as it is to document a $100 million loan. So guess which one I focus on? Because the interest income, net interest margin, yield, however you want to define it, is 10 times larger on the larger loan. So that's what I'm going to focus on. But many of these newer technologies in cities, whether it's physical technologies like storage versus cogeneration, et cetera, or if it's financing technologies like PACE versus energy services agreements, are still not being done in scale. But we have the opportunity as a not-for-profit to do things in a smaller scale because we have a lower cost base, because we have a lower cost of capital, and because part of our mission is really to innovate and deliver financing solutions. So I'll stop there, but those are some of the ways in which we try to address the barriers in clean energy finance.
Yeah, thanks, Curtis. Caroline, you've learned a lot by doing. So my question to you is, sort of as you look outward, what sort of advice or guidance do you have for other cities that are working to advance sustainable financing in their particular locations? And how does the New York Green Bank think about engaging and working with non-New York State cities and other kinds of actors?
Great, yeah. So actually, let me start with the second part of that first. New York Green Bank, as I said, initially was established with $1 billion of New York ratepayer capital. And so what that meant was that our focus on investing that money is entirely on bringing benefits, preservation of capital and green benefits to the state of New York. In fall last year, Governor Cuomo made a couple of announcements. One was as part of the U.S. Climate Alliance. So a group of now, I think, 15 states and territories across the U.S. had banded together, led by Governors Inslee of Washington, Brown of California, and obviously Governor Cuomo. And the objective there is to live up to Paris Climate Agreement. And so how are people doing that? Within these states and beyond these states, they're really saying, you know, part of what we need to do is green financing, and we're looking at green banks. I think one thing that everybody realizes, whatever market you are in, that at some point it doesn't make sense for everybody to invent the mousetrap where they live. And as Peter had said, we've learned by doing, both personally and professionally. But you know, at New York Green Bank, it's taken us 4 years, basically, that we've been up and running, that we've now invested over $460 million. We look, feel, act like a private equity fund. We're staffed by people with private sector experience. And we've got a pipeline as of December of $670 million. Now, to get to that, though, takes a lot of effort. And it doesn't make sense, we think, for everybody, whether it's another state, whether it's a municipality, you know, or whether it's some other regional unit, to try to do this exactly how we've done it. And so what the governor also announced last fall was that New York Green Bank is going to be raising an additional $1 billion in private capital and taking its operations national. So what does that mean? Again, we will be a source of capital. We're just at the beginning stages of this. We're working with external advisors because currently we sit as part of NYCERDA, as our parent organization. So we're part of the state government. So this is really a first of its kind idea about how do you suddenly have, you know, private capital happy to invest in, you know, maybe it's a GPLP structure, maybe it's separately managed accounts. We're just at the beginning, we'll work all that out. But do we need to change structurally to be able to combine with other locations, bring sort of our heft and experience to bear, and leverage the relationships and the knowledge, obviously, at the local level of what these other cities and states need as an origination funnel, basically, for New York Green Bank. So that's the plan writ large. In the meantime, though, really since our inception, we've spent a lot of time, whether it's talking to cities and states across America, or internationally about sharing experiences. We're a founding member of something called the International Green Bank Network, and we as New York Green Bank have certainly benefited from picking the brains of the people who went before us, whether it's the UK now Green Investment Group that recently was privatised and bought up by Macquarie, or whether it's the Australian Clean Energy Finance Corporation. And so we play that role. We speak to people in Europe, we speak to people in South Africa, and as I say, people across the nation. But what I really want to underscore is that this all sounds very lofty, this all sounds sort of big and complicated, but I think as you've heard everybody on this panel allude to, everything we're actually doing, including New York Green Bank, it's very local. It's, it's the aged care home. It's the rolling up of a bunch of residential efficiencies, or in our case, scale and replicability is very, very important in terms of what we have to deliver, but we're partnering with the private sector who may be building landfills, C&I, solar. And then you've got municipalities who are saving a ton of money on their electricity costs, and you're also, introducing all the other attributes of clean energy. And so everything we do, even though we say, well, we're $1 billion, we have to be $2 billion, we're the wholesale financier, everything we're doing in this new sustainable infrastructure, clean energy focused market is very different from certainly what I've done in the past as a traditional project finance, lawyer and banker, where projects were, $500 million and $1 billion. What we're doing is we're providing, it could be warehouse financing or other financing facilities to cobble together a number of these things. So dealing with people who have pipelines so that they can build up a critical mass. We create a new asset class, and then whether it's institutional money or other more traditional commercial financiers are suddenly interested because you have that scale. And I think, everybody on the podium here is playing some role in creating that asset class and this greater liquidity.
Thanks. Kathy, I'd like to ask you a question that goes to one of your responsibilities at the bank, which is the issue around climate-related financial risk and disclosure. We can't fully scale up clean energy without buy-in from the energy sector. Obviously, your bank has many clients in this sector, corporate clients. The task force on climate-related financial disclosure has established expectations for you and your corporate clients. So my question is, how do you respond to disclosures from your corporate clients that are at odds with basic climate science? And how does the bank's exposure to such clients affect your and the bank's perception of the financial risks you may face?
So, how many folks have heard of the TCFD, the Task Force for Climate-Related Disclosures for Financial Institutions? So, it's a wicked acronym, and TCFD, I'm saying the TCFD is wicked, but the acronym is wicked. There are lots of wicked acronyms. First, let me start by saying, in addition to the Bank of America and our partners, American banks and European partners, partner banks and peer banks, will all be responding to and taking in the recommendations of the climate-related, of the task force. But in addition to that, Bank of America has an environmental and social risk policy framework, and that framework sets out how the bank will invest or bank certain types of clients, and it ranges across all kinds of issues. I think there are likely 35 of them. And there are, this is all online, the Environmental Social Risk Policy Framework. And in that, in the Energy and Power section, Bank of America has already made policy decisions about banking mountaintop coal mining. We do not bank mountaintop coal mining, and we have exited coal-fired power plants. And we are further developing the energy and power strategy around what the future looks like and the push to transition this economy to low to no carbon. and, as I said, to the future that we all want. And so the TCFD, and I feel like this is a Bloomberg day, I have to say. I am here at C40, and I went up to the Bloomberg New Energy Finance event, and we're talking about the TCFD, and Mayor Bloomberg and Mark Carney are co-creators of this, and so just can't have this moment without acknowledging the role that he has played in pushing us all forward. And so I will say thank you to Mayor Bloomberg writ large, but all of you that support what he is doing, and it seems to touch every aspect of what I'm doing today anyway. And so the TCFD very quickly divides the risk that financial institutions will face in physical risk and transition risk. And so think of transition risk as a policy change, such as a price on carbon or a demand for requirement of 100% electric vehicles. And then on the physical side, think about a huge hurricane hitting the commercial real estate portfolio of Florida. What happens? What is your value at risk? And so what the TCFD is offering are recommendations for how to create scenarios of 2 degrees, 3 degrees, 4 degrees. How do we stay true to the Paris Accord and keep the temperature of the planet under 2 degrees? And how will that work? And how do financial institutions disclose their risk? And so I want to focus on the risk in the conversation and in that quantification, but I also want to focus on what that risk allows us to reveal about the opportunity for us to make the transition that we want to make. And so thinking about understanding the physical risk of commercial real estate portfolio, and I think you will find that many, many banks don't hold investments for very long. And I'm learning, as I said, all the lines of business that oftentimes we won't keep an asset more than 7 years. And so when you think about, other than in mortgages, so what does that mean for us? And so we'll be working side by side with our peer banks, and many of you may know about an effort that the UNEP Finance Initiative has with a group of European banks to publicly create open source methodologies around testing the bank's portfolios, and they'll be putting out a report shortly, both on physical risk, which is a little bit later than the transition risk, thinking about specifically about energy and power. And so when we think about, I think your question is, how will we make a decision around TCFD and the clients that we engage with and with whom we bank versus what we learn and reveal from those portfolios? I think we have solidly made that commitment that the direction that we're going is away from coal and away from fossil fuels, but we have to do that in a responsible way. And so the TCFD is going to be yet another tool for us to identify the risks and quantify them, but also chart a path forward for where we want to deploy the capital of our bank toward the things that we think that sustain the planet.
Thanks, and we thank both you and Ken. We appreciate you both stepping out of the Bloomberg New Energy Finance session today to come down and be with us.
My pleasure, yeah.
Ken, what questions do you find investors asking as they consider an investment in one of your funds?
You know, if you think about this over time, Peter, when we launched, Impax was kicked off, as I said, 20 years ago by two bright young ex-McKinsey consultants, and when they started, the question that was being put to them was, if we give you some money and you only invest it in companies that are doing environmentally positive things, can you earn us a return at all? Second question, can you earn us a return as good as the market? How much are we giving up to do this good thing? And that was the challenge that they faced initially. 20 years and $16 billion of capital under management later, we don't have that question raised to us quite as often, but each new line of business, each new approach has that question put to it. So the real estate fund strategy I was describing had investors asking whether it was possible to, in fact, do this cycle of buying and retrofitting and selling properties in a way that made financial sense for an investment institution like ours. And the success of the first fund hitting its financial targets, I think, helped address that concern, but we'll face those same kinds of questions. Can I really make money doing this? A little bit easier to settle that question in the listed equity space, but private equity, it does depend still on the track record of the individual manager. The other thing that comes to us, that came to us then and still comes to us, is people coming in and asking, well, I'm making investments that seem to me as if they're going to be good things, they're nice stories to tell, but are there really any impacts? How do I know if the money I'm putting in this company versus that company is having a positive impact? And we honestly didn't have an answer for that question for a very long time, but the folks at the Global Impact Investing Network came to us about 5 years ago now and challenged us to come up with a better way to look at the impact of a listed equity portfolio, which is difficult to do because you're owning shares in companies like Siemens, for example, which does all kinds of things. And it's much harder to pin down where their environmental involvement is. But we worked on that and came up with a schema which we've now put into place and have rolled out for the last couple of years across several of our leading fund strategies. And it enables us, with the assurance of an Ernst & Young team, to show the amount of renewable energy generated, the amount of carbon avoided, the amount of water that's treated or processed, and the recycling and resource recovery results of the individual companies in which we're investing. And I think that is giving investors a higher degree of confidence that their investments, there is in fact a double bottom line. They're seeing their financial returns, that's easy to track, but they also can now see the impact of those investments in the real world. I think it's a goal that all of us who are investing in sustainability need to keep in mind.
Thanks, Ken. Curtis, sort of keeping an eye on the clock here, so we have a couple of minutes for questions at the end. My question is, both you and Caroline from the Green Bank are trying to facilitate new projects and new investment opportunities. How is what you're doing different, and can you replicate your function elsewhere as green banks have done in some other states?
Sure. Well, first of all, the idea of a not-for-profit corporation doing urban clean energy is not a new one. NYCEEC has been at this since 2011, but in deference to the former mayor of Toronto, Toronto Atmospheric Fund has been doing this since 1991. Yes. You have the London Green Fund, you have Sustainable Melbourne Fund, so there are other places in the world where this is happening. There is the idea of providing capital that is maybe more patient, more willing to live with complex, small transactions as a bridge to getting to larger, more scalable transactions that can be financed by the private sector. So I think that has applicability broadly. The other thing I would say, though, beyond just the capital, whether it's provided by NYCEEC or it's provided by the New York Green Bank or other similar entities, it's an expression in the United States, all politics is local. I don't know if that's an expression that's a global one, but all politics is local. I would submit that all clean energy investment is local. Because you're dealing with the utility company. They have their tariff structure. They have their interconnection policies. They have a whole series of rules and regulations. You're dealing with local laws around building codes, zoning, permitting, fire codes. You have funding sources that may be specific to that community, whether it's foundations or CDFIs or the like. You may also have different sets of policy goals. It could be driven by resilience, climate, workforce training, economic development, affordable housing, other forms of social equity, all of the above or just some of the above. So having an entity that can really navigate the local landscape and work with the private sector to really, not to crowd out the private sector, both the Green Bank and the NYCEEC are firmly committed to crowding in private investment. If we do really good jobs, Caroline and I will be sitting on a beach somewhere because the Green Bank and NYCEEC may not be necessary because there's a flood, this wall of money of private capital going into these investments. But for the time being, we work at 1359 Broadway in our respective offices, and we're helping to drive the flow of capital into these more nascent areas. So I think in addition to the capital, the local knowledge is really, really important to drive the investment. And the other thing I would say is independence as well. There are other commercial entities that could provide a lot of the local knowledge and the technical expertise and the policy navigation, but each one of them is going to have a commercial bias. So having an independent entity, I think, is incredibly valuable too.
Thanks, Curtis. Before we ask you for questions, I just want to take a quick moment to ask the audience whether you happen to be an issuer of debt or if you're an investor to consider affirming the importance of incorporating climate-related risk when planning, financing, or investing in infrastructure and capital projects. So if you can remember this website, greenbondpledge.com, go visit it, become a signatory. It's easy to do. Questions from anybody?
Hi, my name's Skyda Almeida. I work for Macquarie Capital, formerly C40, always C40. I have a question. I work with pension funds, sovereign wealth funds, and infrastructure funds. And the three issues that Curtis raised are the ones that come up most commonly in terms of barriers to low carbon investment in cities. On the issue of scale, I wondered from the panelists which low carbon urban solutions you think offer the most promise in terms of scalability, whether it be renewables, energy efficiency, transport, something else.
Kathy?
Just looking at the list of the ways that the green bonds proceeds are being used just in the U.S., it's obvious that the water and wastewater and drinking water projects are, in terms of volume, the biggest. And looking at adaptation projects like pumps to decrease saltwater intrusion and those sorts of things, those are highly replicable in coastal cities and increasingly are included in those packages of water bonds. So that's one, and I'll just use the one, but happy to chat.
Yeah, for me, I mean, this is where I think Curtis and I overlap, NYCEEC and New York Green Bank. I mean, energy efficiency, as we look at it, it punches above its weight in terms of the money invested, and I think in concentrated urban areas, there are still, some issues that need to be worked out, and in New York State in particular, with Earth Day coming up very shortly, we're going to see a big announcement, because I think all of our experience across New York State has been that energy efficiency has been much harder to get done in the volumes we think it can and should be done. And I know the state is pushing some initiatives, and New York Green Bank's going to be part of that. So watch this space, but that's definitely my pick.
The other thing, just to add, is storage. I think storage in the near term, we're not there yet. Storage is, depending on who you ask, is solar in 2008 or 2012. It still has to come down the cost curve, but storage is going to be absolutely part of the mix if we're going to optimize the generation fleet in the various jurisdictions and reduce the embedded cost of capital and allow for a greener generation mix.
If you're interested in learning more about the water issues that Kathy brought up, Ceres not long ago published a water toolkit to help identify investment risk, which issuers should also be paying attention to. Another question?
Hi, I'll stand up to you. Hi, Sophie Evans with Willis Towers Watson. I just wanted, we talked about green financing and the certain sectors. I wondered if the group could speak a little bit about how we can collectively prioritize adaptation financing. We hear a lot, I work in the insurance sector, so we hear a lot about mitigation financing, and I think we had a very loud signal from the most recent COP last year in Germany that we need to do adaptation financing now. And for those who, and Kathy, I don't think you've seen the tweet, but you've just pledged 135 billion for investing in this space at Bank of America. So thanks very much. But how do we move the dial on adaptation financing, and how do we impress upon those investors or those working in this space to act now, that we can't just do the mitigation and then the adaptation? Those two parallel tracks have to take priority.
I'm happy to take a quick response. I couldn't agree more on the need for the adaptation. And if you look at the scenarios of where we're headed, and the most recent, Shell put out a scenario called Sky, which looks at how we would energy-wise keep ourselves to the Paris Agreement. It would energize us, pardon the pun, to invest in adaptation. And I think we will need to aggregate our efforts and create financing, whether those are facilities or combinations of financing with parametric insurance policies, or, as I mentioned, resilience bonds, that we need to be thinking quickly and begin to act. And we were a part of a smaller workshop yesterday with Houston and New Orleans and somebody from San Francisco, and thinking specifically about adaptation financing. And those challenges are not, the name of the panel is investing long term. I would say that one is more like investing long term in the short term, because this is something we need to do right now. So it's not a quick answer, but it is something that we are paying very close attention to. And as I said, looking into the proceeds of use of bonds, but thinking about new products that have metrics that are associated with them around resilience and adaptation.
Ken, I'll give you the last word here.
You know, I'm very encouraged just in the last couple of years by in the financial community by the increase in interest in investment in what's characterized as resilience. Because this ties together both typically energy efficiency, clean energy, and the ability to assure that the kinds of problems that we had down here a few years ago don't repeat. And I think that's a theme which, if it continues to gain traction for investors generally, will prove to be tremendously valuable to all of us longer term, because at the end of the day, resilient infrastructure is essential, and if we're not looking at both sides of that equation, we won't be successful in solving the challenges which clearly lie ahead of us.
Thank you. Our very large clock here is reading 00. So we'll be around. If anybody has questions, try to grab us out. Yes. Did you have another question? I'm not quite sure. We've got some. Go for it. No, we're done. We're getting the cue. Thank you very much to the panelists.